You are listening to Keystone's Stock Talk Show, episode 325. It's great to chat with you again. This week, I kick off the show with a snippet from a speech I gave at the World Outlook Conference this past week on the folly of macro forecasting. Brennan reviews Amerigo Resources Limited, symbol ARG, and why taking profits in high-flying cyclical businesses is often the best strategy. Brett has our dog of the week, HIMS and Hers Health, symbol HIMS on the New York Stock Exchange, which operates a telehealth platform that connects consumers to licensed professionals. The stock has had a very volatile year, hitting over $72 recently, closing down below $17. Brett will let you know what is driving the declines and if it presents an opportunity. Finally, Rahil reveals DBOX technology, symbol DBO, on the TSX, which builds motion and vibration systems for seats and platforms so you can physically feel what's happening in a movie, video game, or simulator, all perfectly synced with the picture and sound. Driven by a surging EPS, the stock has jumped over 500% in the past year. Rahil lets you know current valuations and whether the growth can continue. All right, let's get to the show. I'll welcome my co-host, the Killer Bees, Brett and Brennan, and our newest addition, Rahil. Welcome, gentlemen. How you doing? All
Doing
back
well.
from our adventures in Vancouver at the World Outlook Conference this past week. I'd like to say anybody who came up to the booth, shook our hand, the feedback was great. It was great to see clients in person, new clients. I had a great time speaking at the event. Hopefully the audience enjoyed that. We hosted a lunch as well. We went to a couple dinners. So a lot going on in a couple days, but we had some nice weather at least one of the days in Vancouver. So it was great. It was a good event, well attended. And thanks for the organizers and to Michael and all that who attended the event, and anybody who came up to us and said hi. You guys have a good time?
I had a great time. Like, just so much positive feedback. It was great. It's just great having clients actually come up to the desk and, thanking us for the work that we're doing. A lot of the times when I'm sitting here in my home office, it's out of sight, out of mind. I don't get to see that. Like I even said to Rahil, we went for supper. We went to not dinner, but supper, to Cardero's, and we're sitting there at the table, and I look over at him, and I'm like, man, this really, really, puts the fire under my ass here to, or all of our asses to continue to find some good stocks, and of course, sorry, I'll say, Rahil said to me, he was like, actually, yeah, it's funny that you say that, Brennan, because before we went for supper, I was actually like kind of having a nap, and I was dreaming about stocks. That's what he said to me.
Awesome. No, but it really does. I mean, you're there. You produce good results in the past, but you see like the faces and the impacts it can have on clients, right? And our industry is always about what have you done for me lately. So we go back to the grind and find, existing companies that we continue to update. Do we want to continue to own these? And then new companies that we might want to recommend to clients over the course of 2026 into 2027. So it does light a fire under you when you see like the positive impact that, buying great companies, investing in them, holding them over the long term can have on real people's portfolios. It lights a fire. Like, we want to make money. We want these in our portfolios. We want our clients obviously to make money. That's the only way we make money over the long term. So yeah, it lights a fire to continue to find those good companies for our clients. And that's what we'll do. Yep. Any other interactions? Anybody want to shout out?
No? Yeah, I mean, I do want to. It was funny because I had my girlfriend there, so she exists.
Yeah, we got to touch on that.
Ryan,
we did figure out that she exists. She seems very nice, very kind, and the question now becomes, what is she doing with Brennan? Right? That's
this is fair.
Obviously. No, she seemed awesome. It was great to meet her. She did have a sign that said, this man kidnapped me, and she handed it to me, and I said, okay, well, we'll see what we can do. But Anyway, she seemed great. It was good to say hi to her, and we had proof of life. So we're gonna stop giving Brennan a hard time.
Yeah, exactly. And
No, we won't.
she found Ryan's speech quite insightful to actually understand what I do for work, you know,
Yeah.
which I find funny. Even one of my buddies, his fiance's friend, every single time that I see her, she's like, "I'm convinced, Brennan, your job isn't real." But no, it is real. We're
So
looking for businesses. We're looking for stocks.
yeah,
Um,
we think your girlfriend isn't real. Your friends think your job isn't real. Life's tough, right? You're just
Life
living in a
is tough.
fantasy world,
But
basically, right?
you know what was real? We went to Carly and I. We went to the Vancouver aquarium, and
Beautiful
it
day.
was
Yeah.
a beautiful day. It was a great time, and I got to see the axolotls. Um,
Uh,
and I even made
that
sure
is
that
you.
Carly snapped this photo of myself. You
That's an
know,
angry looking axolotl right there. What's going on?
I know.
No,
I know. I was just trying to make a dumb face, and I mean, it's pretty easy for me to do. So
my daughter went as well. Like she's axolotls are hugely in right now for the
yes,
kids. So she had an awesome time there. It is that aquarium. We're doing an ad for them right now, but it was a great. It's a great experience. It's cool to go there. Brennan had a good time, so that's good to
yeah.
see.
And before we really get into the show, your Seahawks, they did it.
Yes, you know what? It's crazy. It's what usually I'm on the absolute edge of my seat. Perhaps it's because I was absolutely dead tired, like literally
Yeah,
dead tired but after that event this weekend. No, but it's crazy. It never seemed to be in doubt. I mean, it was 9-0. Although
yeah,
not the most exciting of games, I'll tell you, but it's always exciting when your team actually wins something because my teams usually lose everything. So it's just such a I felt like, is this real, because it doesn't usually happen for me, but it was tremendous. I had seen them one Super Bowl in the past and get one ripped away from them, but it was a clinical defensive performance, and then they came
yeah.
away. And it's funny because I live right next to the US. From my balcony I can see the US, like Blaine right there, the city that's right across. And like the moment they won, boom, fireworks going up from houses, from like the town, the city there. It's just crazy. I mean, obviously, football is like, it's it's a religion down there, basically.
Yeah.
So I mean, we love it too, but it's a whole different level. And yeah, because that was just, it was going off down there. I'm sure they had a great time in Seattle on Sunday night. They're probably still going now. There'll be a parade. It's super cool to see. I was happy, and
Mhm.
now we get to watch the Olympics, and no
Yep.
Canucks for at least 3 weeks, which is, they haven't lost a game in like 5-6 days. It's impressive, right? Because they haven't played, right? But yeah, that's
Yep.
what happens. Cool. All right, we might as well get to the show. I've actually got 2 client calls booked right after this, so we got to get to that. I'm going to start, unless nobody had anything else, right? I'm not cutting everybody off, probably. This is a little snippet from my speech at the World Outlook event. It's about some timeless insight on the futility of macro forecasting. Well, um, now Jeff Bezos famously asked Warren Buffett why people didn't copy his simple investment strategy. Buffett simply replied, "Because nobody wants to get rich slowly." I mean, it's very true. Investors often act like they have the attention span of, say, Justin Trudeau at a Spirit Halloween store, because he, likes the costumes. Uh, but you shouldn't, because Buffett kind of undersells this, and that being the power of buying great capital compounding businesses. You do not become one of the richest people on the planet, and Buffett is worth 150 billion in change. Uh, you don't become too slowly. In fact, buying a number of great businesses can get you rich in a reasonable amount of time. We say 8 to 12 of these companies in your portfolio, you're positioned kind of at the corner of opportunity and timing. Not every potential capital compounding business works out in your portfolio, but this sets you up in a portfolio to take meaningful advantage of those stocks that do. I would remind clients, people that are watching this right now, that at that show, 3 years ago, we had recommended Hammond Power in the $25 range. It trades at $200 today. Companies like Boyd, which is up 10,000%, Expel, which is up 3,700%, Firan, up 1,000%. They were all bought using this capital compounding strategy. Nearly 1 year ago to this date, we recommended Group Dynamite, which aligns perfectly with this strategy, the type of business Buffett would have bought if he could. It's too small for him, but you can have this in your portfolio. 10 months ago, it has changed portfolios over that period. I'll give you an anecdotal example of why we believe it is it's not a good thing to follow macro forecasters. I took a call from an investor who had bought Group Dynamite on our recommendation at $15 mid last year. She went on to say that she sold it about 45 days later because she heard a market forecaster on the radio essentially stating that markets were going to tank in September. She became scared and hit the sell button. 6 months later, the market did not tank in September. Group Dynamite shares were at $75, up 400%. I want to say stop listening to macro forecasts for your portfolio and continually making adjustments based on them. People act like this in the stock market all the time to their own peril. Remember, a stock is not just a symbol, it is a share in a real business. Buy good businesses, allow them to grow over time, not in days, not in months, but perhaps most importantly, you use this in years, but you got to ignore the noise. Anything else is really just gambling in the market. Okay, so how about another business? Alphabet was our top Mag 7 pick this past year, a stock that also perfectly fit Buffett's strategy. How do we know this? Well, 6 months later, he bought it. He bought just a little bit more than us, but I call him a bit of a copycat. I'm kidding. It's always flattering when Warren Buffett is investing in a company that you have recommended. And we've recommended Alphabet for 6 to 7 years. When it's funny because we were at the event and I said 6'7" at that time. I just realized that, and I said, my daughter was there, and I was 6'7". I'm never going to hear the end of that, and I didn't. I haven't heard the end of that because she watched that. But we recommended Alphabet originally back when it traded at $60. We still like it long term today, although it is at the high end of our valuation range. 10 to 11 months ago, it was on sale. Mr. Market will give you great opportunities from time to time. We identified it here. This was a webinar we gave in April of last year in the $160, $180 range. This is our Mag 7 comparable peer analysis. We found Alphabet at that point to be the pick of the litter. The stock is now up over 100% since April. So again, holding a number of these coiled spring capital compounders in your portfolio, patience is key. Doesn't take a ton of patience at times, but it can. This is a strategy not designed to mirror the market. It's for those who want to be different from the market and beat it over the long term. So I'm going to give you the basics of capital compounding as an investor. Using the power of time and compounding, wealth is built by letting investments grow over decades, not days. Invest in businesses for the long run, ignoring short-term market noise. It is a pairing of value and growth investing. Seek companies with strong fundamentals, competitive advantages, solid leadership with sustainable growth, trading below intrinsic value. You don't need complex strategies. Buying a piece of a great business is enough. When prices fall, buy more. Don't sell in panic, as we saw as that anecdote on Group Dynamite. Focus on what you can control, and that is the type and quality of businesses or stocks you put in your portfolio. Now, I'm going to linger on this last point for a moment. One of the common mistakes we see investors making, and I gave an anecdote on this, is focusing too much on the macro, something they cannot control, and in particular, macro forecasts. Investors have a long history of wanting to know what the market does next, and why wouldn't they, I guess? It's seemingly the quickest way to riches, but it's not. But that demand to see the future has a constant supply of people foretelling the future and what stories they will sell you. They weave confident tales around a few data points that prove what the next stock market move will be or the next move in the economy will be, except it's never that simple. Take inflation. It's driven by the daily financial choices of billions of people. It's the sum of every worker negotiating a paycheck, every company setting a price, every consumer deciding whether they feel safe enough or wealthy enough to spend. When you realize that inflation is tied to the collective emotions and shifting needs of the entire planet, you can see why even the Fed can't get it right. It's a complex mess. There are too many unknowns, yet there are folks arrogant enough to predict or think that they can not only predict inflation, but what the Fed will do about it next. You'll never be able to control the macro, but don't take it from me. Take it from the smartest investors over the past 100 years. They believe that macro forecasts are for fools. They create more harm than good in your portfolio. Peter Lynch said economic predictions are a total waste. Ben Graham, economic events rarely unfold in the way stock market people forecast them. John Templeton, in his 60 years in the stock market, he found little use in short-term predictions. Peter Bernstein, he found predictions can end up being so far from the mark as to be more dangerous than useless. Warren Buffett put it succinctly. He does not want to predict what the stock market is going to do in the next year, stating he is smart enough to know he doesn't have the faintest idea. Finally, Howard Marks. He believes there are two types of forecasters, the ones who don't know and the ones who don't know that they don't know. Now, what can you do? What can you do in your portfolio? In essence, Marx believes that because the future is unknowable, investors should focus on positioning for long-term and buying undervalued assets rather than trying to predict macroeconomic events. For us, the risk is in listening. Investors who rearrange their portfolios based on these soothsayers' forecasts end up worse off than if they've done nothing. And we saw that in the example of Group Dynamite in the real world. Now, no matter how much we want to know what the market is going to do next, uncertainty is here to stay. The future is unknowable. Nobody has the power to foresee it. The quotes I just presented are from insight from the best investors over the past 100 years. The solution is to ignore the fortune tellers, stay the course when building a quality stock portfolio. You'll always be fighting fear in your portfolio or your wealth building journey. But if your portfolio consists of businesses that make money and make more of it over time, hopefully you can sleep at night. Now, what we would say, our suggestion in your portfolio is to build your own portfolio. You can take control. If you want to beat the market, you can't just be the market. If you just want to mirror the market, you can buy 3 ETFs, a Canadian ETF, US and international, 33%, 33%, 33%, and call it a day. If you want to beat the market, you can't own hundreds of stocks because you are the market. You can't just own 2. There's a simple formula that we would like to use. You can create your own simple equity portfolio. We call it focused diversification. 20 to 25 stocks built gradually over a 12 to 24 month period, ideally 2 years. It reduces the risk to short-term market corrections, provides flexibility to add new positions as new opportunities as we come up with new research over the course of a 24-month period. The process, if you became a client of Keystone's today, or if you wanted to build your own portfolio, you could start with 3 to 5 high-quality positions in good businesses, add 2 to 3 new stocks per quarter, and you're going to build that simple 20 to 25 stock portfolio over a couple of years. We come at it as a model from 4 core areas. Your 5 or 8 Canadian small cap growth stocks, all profitable businesses. Your 5 or 8 core Canadian dividend stocks, again, all profitable dividend growth stocks. You're looking at 5 or 8 US small cap growth stocks and 5 to 8 core US large cap and dividend stocks. That puts together into a beautiful portfolio of 20 to 25 stocks. That's a big, beautiful portfolio for you. And that is all on my segment for this week. Are you guys still there?
I'm still here. Yeah. I mean, I don't have too much to say because
your
my
segment
section
extends
is,
on it. So yeah.
Yeah, exactly.
We can
So do
move
the
to
other
yours.
guys want to say anything?
Oh, you're bringing us into your finally. But no, it's always interesting when we see like those really hysteria crashes like we did last year with the tariffs. Like I always see those personally as opportunities, but it really shows your mentality is you might this is why we say you need a diversified portfolio. Is if you are over concentrated in, let's say, 2 or 3 names, you have a 20-30% in position, and you suddenly see a drop 30%, you're probably not going to be a buyer of that stock. You're going to be panicking in your head. Oh no, I just lost a tenth of my portfolio just in this one name. So instead of buying more, you sell, even though the underlying company itself is good, and you just need to wait it out. So if you're investing for the 3, 5, 10 years, like what we want to do, you're going to be fine. If it's a good company underlying it, you have a solid thesis, the thesis hasn't broke with the macroeconomics, and you'll do fine over the long term. And that's really what you need to watch out for. It's just not really panic more than anything. It's pretty simple as far as that goes.
And you need to have the plan ahead of time, because and this is something we're really stressing. We'll probably talk about this in our webinars that we have coming up. If you don't have that plan ahead of time, it's really hard to formulate it or execute it during a crash, because everybody is panicking and you just think everything is a falling knife. You have to have businesses you want to know or own, identified in advance, know that you're going to buy them. And it may go, that business, that individual stock you buy, or the 5 that you buy, may go lower initially. But if you bought them and they're 30% on sale and they were already relatively reasonably priced, you've got a discount, and then you're looking 2 to 3 years out. If you look back at the history of the markets, those are the best times to buy. They're the hardest times to buy for most often for people, because they think it's probably just going to continue. It doesn't. In the good, solid businesses, some companies that were trading at ridiculous valuations, you have to have them identified ahead and know that, this needs to go down 75% for me to buy. And if it goes down 50, it's still not on sale. And there's some of the SaaS companies right now we're looking at, have dropped 50% in 3-6 months. They're still on like core earnings. They're not cheap. Now there are some that are looking cheap. So, these are the ones that you want to take advantage of. Alphabet last year, I keep hearkening back to that, is a time when you got it for 16, 17 times earnings. It was growing above that on a revenue basis, earnings well above that. And we didn't think that company was going away at any time. So there's likely a couple other opportunities coming up, but I have to stress so much that you just need to have that plan ahead of time. As much as you think, I'll wait and wait and wait till the correction, then I'll buy. Most people that have waited, then they get even more panicked during that correction time and don't buy, and they end up buying when it comes back up 30% or something again. Or they then say, oh, now I missed out, I'm going to wait for the next correction. So have that plan in place ahead of time and know that you're going to make a buy, and you will not pick a perfect bottom. It is impossible to pick a perfect bottom. If you buy a stock that was relatively reasonable and it's 20% off, it's just like if you go to the store and you want that shirt and it comes 20% off, you're going to feel better if you bought it. It may not be the absolute bottom, but it's a good company. You look back 5 years and you got it at a discount, you will thank yourself.
I was listening to a podcast with Howard Marks on it, and the podcasters were kind of asking him, like, the markets are expensive, what do you do? And Howard Marks, he's always been very, very defensive, but it's just the classic allocating more into bonds when the markets are pricier, less equity. And then of course, when valuations come down, to rotate more out of bonds and more into equities. And the interviewers or the podcasters asked him, when do you know the time to buy? And, he gives, like, Howard Marks gives it's a very generalized or a very simple answer, but he says, the time to buy is when you won't want to. You don't want to, because it's scary, because everybody out there thinks, again, that we're trying to catch this falling knife. Of course, you're not going to catch the bottom. But I just thought that it was kind of insightful, and it was kind of interesting that, you really have to go against, your first emotions, essentially.
Yeah. And again, I'll go back to knowing the businesses ahead of time, right? So you're not having to scramble and do a ton of homework when there is an opportunity, knowing that business ahead of time. And then, we'll check in with management during a period like that. Like, we talk to many of these companies during that tariff or Liberation Day fall. And, what happened the last time during a tariff scare with Group Dynamite, we actually found that their margins increased. It benefited the business. So when it dropped to $10, we had reiterated our buy, and you're not always going to get it right. You're not going to get the absolute bottom, like we said, but if you're buying these good companies, yeah, and they come on sale, that's when you want to buy them. And people are always saying, "Oh, should I back up the truck at certain times in the market?" If there ever was a time to do that, it's when everybody else is selling. It's very hard to do, but again, have the plan ahead of time. Know you're not going to get a bottom. So if you've bought 10, 20% down and it goes 30%, don't then sell. That's the worst thing to do. Just you're making that buy for 3 to 5 years out often. That seems like a long time. It's really not.
Yeah, I heard that a few times actually at the conference, specifically with Group Dynamite. It was, I didn't catch the bottom. I bought it at $13 instead of the bottom was somewhere like $10.50 intraday or something like that.
That's
and
what
it's, oh no, only a 500% return over 8 months. Don't worry about the exact timing. There's only ever 1 or 2 people who just happen to luck out of the thousands of people who are likely buying or selling at that time.
Yeah, and to give you an idea of like the, when we're modeling out where we thought Group Dynamite could be, if it could get to $70 in 3 to 5 years, that would have been a tremendous win for us, a tremendous win for clients. I mean, it got there in 6 months, like 8 months or so. That is not typical. That is atypical for a company to do that. But the more of those type of companies that are positioned at a discount to their peers, like Aritzia is a company we follow. It was 39 times earnings at the time we recommended. Group Dynamite was 12 times. Similar same store sales growth, good margins, good balance sheet. So you got not only better margins out over the course of this year, better same store sales, so perfect storm. You also got a re-rate on the multiple, meaning the market said, now we'll not just pay 12 for you, we'll pay 30 times for you. So that's how you get a perfect storm of a stock really jumping. But you've got to have those stocks with that profile in your portfolio. And if one of them or 2 of them in a given year, has, as the kids would say, a glow up, because I guess that was a glow up for that stock, right? That's how you can really, beat the market in your individual portfolio over the course of this year. And you got to give yourself the opportunity. So you're buying those profile of businesses, because not every one of those companies is going to work out. Some will not work out in your portfolio. Okay, I could go on and on about this. I'm going to let Brennan actually talk about kind of using Amerigo as an example of cyclical companies and sometimes taking profits there. I believe that's what we're talking about.
Yeah, exactly. Like, it's not like this section or segment isn't a your stock, our take on Amerigo, but it just kind of goes over a couple of emails that I got from clients. So, just jumping straight into this here, like a few weeks ago, I did get a couple of emails from clients asking why we had recently taken profit on Amerigo, again, ARG on the TSX. And they're a copper tailings processor located in Chile, which we had originally recommended at $1.28 back in 2021. And these clients' comments included such as, I totally agree on the profit taking, but on a price to free cash flow and enterprise value to EBITDA basis, it does not appear overvalued. And the other email that we got, copper's price should continue to go up, as it's hard to argue with the basic economics of supply and demand. And I responded that the sell report indicated that higher risk tolerant clients can continue to hold the stock, as there is still an opportunity for another leg up due to an expected production growth in Q4. But we view it as prudent risk management to take profit in a cyclical during heightened sentiment, especially a one asset company with declining long-term production expectations. And considering we're up over 250%, including dividends, since our initial recommendation. So the only thing that could really drive the stock higher longer term is if copper continues to go higher. And here I'm just pulling up the actual investment summary from the sell report, outlining this sell thesis here. And you can see, we indicated that, clients could continue to hold on who were, higher risk tolerant clients. So again, in this segment, I'm really going to just look at both of these questions here and how I answered them, and kind of complement Ryan's folly of macro investing by looking at some real world examples when I touch on the second question just on that simple, isn't it just a simple supply demand equation? So first, looking at what Amerigo's valuation looks like today. Well, Amerigo provided guidance with free cash flow of US 35 million for fiscal year 2026, assuming a US 480 per pound copper price. They also note that for every 20-cent pound increase in the price of copper, this would increase free cash flow by about 4.1 million, again, US. Of course, the opposite is also true if we saw copper go down. Now, if we remove the net cash position on the balance sheet from the US market cap of approximately 675 million, we get an ex cash market cap of about 650 million, which divided by the free cash flow guidance of US 35 million, this provides a forward price to free cash flow multiple of about 19 times. Now, if copper can stay in its current range around 580 per pound, then this would lead to potential free cash flow for 2026 of about 55.5 million and a forward price to free cash flow multiple of about 12 times. Again, this is after removing the cash balance, which is more reasonable than, the 19 times, but it's still not screaming value in our opinion. And to put this all into perspective, when we originally recommended ARG, I sound like a pirate, ARG, when we initially recommended Amerigo or ARG at $1.28 in December of 2021, the stock was trading at less than 3 times trailing free cash flow. This is trailing, but still, it is still very representative of the value that when we were buying it compared to where it is right now. So relatively speaking, we believe the current valuation is more on the expensive side, given it is a one asset company with flat or declining production expectations longer term. Now, to answer the second question regarding whether copper's price should continue to go up, as it's hard to argue with the basic economics of supply and demand. But what I said to this is that, as Ryan mentioned earlier, expert forecasters have gotten macro forecasts wrong time and time again. The macro economy is very complex and not something that is simple or easy to forecast. And I went into some examples here, and here's a few of those. So in late 2022, there was a near unanimous consensus among economists that the US would enter a recession in 2023 due to the Federal Reserve's aggressive interest rate hikes. And Bloomberg Economics actually published a statistical model in October of 2022. I show that where the circle is there on the chart. That's the S&P or SPY, S&P 500. And this was in October of 2022 when they published this, stating that the probability of a US recession within the next 12 months is exactly 100%. And this sentiment was echoed across Wall Street, with firms like Wells Fargo and JP Morgan bracing for a hard landing. But of course, the recession never happened. And instead, 2023 saw 2.5% GDP growth, the lowest unemployment rate in 50 years, and a massive stock market rally led by the Magnificent Seven. And consumer spending also remained resilient despite high rates, and the economy achieved the soft landing that most analysts deemed impossible. So, if you were selling your stocks then in anticipation of, what forecasters were saying was basically 100% going to happen, well, that wouldn't have worked out so well. Another example is in early 2022. The narrative was simple and terrifying for the potash market. Russia and Belarus, which provide about 40% of the world's potash, were being sanctioned. This was due to the outbreak of the Russia-Ukraine war. Supply was going to vanish and the world would starve without fertilizer. And analysts and CEOs predicted a multi-year supply crunch, and prices for potash, or MOP, spiked from roughly $300 per ton to over $1,000 per ton. And the consensus was that prices would stay at decade highs indefinitely. And Nutrien, or NTR, the world's largest producer, announced plans to ramp up production to 18 million tons to fill the permanent gap. And what actually transpired is farmers did something the models didn't account for. They just stopped buying. So the demand kind of vanished. They instead started to mine the soil using the residual nutrients from previous years rather than paying $1,000 per ton. And simultaneously, Russia and Belarus found a backdoor or backdoor routes through China and India. And by late 2023, prices crashed back towards $300 per ton, and Nutrien was forced to indefinitely mothball its expansion plans. So they got it wrong. Now, another example is in late 2022. Lithium was the hottest trade on the earth at that time as the world pivoted to electric vehicles, and analysts predicted a perpetual deficit where supply would never catch up to the demand for batteries. Prices for lithium carbonate hit an all-time high of nearly $80,000 per ton in late 2022. And major banks like Goldman Sachs initially projected that prices would stay elevated for years due to the green transition. But again, what actually transpired? Well, prices collapsed by 80% in 2023, falling to around $13,000 per ton. The masses were wrong as they underestimated two things. And number one is there was a massive shadow supply of lithium in China that was profitable at high prices. And second, the sudden cooling of EV demand as consumers balked at high prices and limited charging infrastructure. So, the adoption wasn't as fast as they had thought. So, will copper go higher or lower? The simple answer is I don't know. Right now in early 2026, the consensus on copper is overwhelmingly bullish, with some analysts calling it the most critical asset of the decade. However, a small but growing camp of skeptics led by Goldman Sachs are beginning to warn that the market has gotten ahead of itself. Now, most financial institutions, JP Morgan, Citigroup, Bank of America, project that copper will average between 11,000 to 12,500 per ton in 2026, with some bull case scenarios reaching as high as $15,000. And this is due to, of course, demand from the AI power surge and AI data centers on top of, that green transition, EVs and solar, as well as supply disruptions and copper deficits and tariff front running with companies, panic buying and stockpiling inventory in the US. But on the flip side, just like the potash example from 2022, the masses might be ignoring the cure for high prices, such as, copper replacements like aluminum, scrap copper recycling, or a slowdown in the AI build out or spend in general. And Goldman Sachs is actually predicting an 18% drop by the end of 2026. And they argue that record prices have finally cured the shortage by killing demand and encouraging a massive surge in scrap copper recycling. Now, again, I'm not trying to make a case for either the bull or the bear here. Again, I have no idea what is going to happen, but what history has taught us is that commodity stocks are meant to be bought in cyclical weakness and sold into cyclical strength. Just like when we bought, Amerigo back in 2021 at just 3 times free cash flow. That seemed like quite compelling value at that time. But anyways, I think that that's pretty representative of, just kind of the folly of macro forecasting, and just kind of, allows clients or listeners into our heads on, what we're looking for a business. We think that Amerigo continues to be a good company, great balance sheet, but if you were at the World Outlook, you would have also seen in Ryan's presentation that the number one driver of share prices over the long term is per share earnings growth. If a company isn't expected to grow its production And it's simply, the only way that, we're going to see earnings move around is basically due to the volatility of an underlying commodity. Well, that doesn't give us this growth thesis, for the stock to continue to grow over the long term. It's just not something that we're going to, put our necks out there and try to forecast. Again, forecasters get it wrong time and time again. Anyways, my rambling's done. I'll open it up to the gentleman.
Yeah, no, it's a really good summary. And I think at the end, history teaching us that commodity stocks are meant to be bought in cyclical weakness and, sold in cyclical strength is, a big takeaway from that. And, you put it succinctly too as well with Amerigo. In terms of their production, one of the things we looked at was that, you go back to 2021, 63.4 million tons. 2025 was 62.2. So it's actually down in terms of aggregate production over that period of time. And there's not an expectation for growth over the long term in terms of their production. So, one of the things we'd like to see and one of the boxes we'd like to check off is production growth as well. Now, we're also saying not including dividends, and there's significant dividends here. The stock was up like 270, 260% over that period of time. Paid us generous dividends over that time. So we're selling into cyclical strength. Predicting what will drive the stock price higher would be higher copper prices. We are not fools to think that we can predict the actual direction of copper over the next month, year, or 2 years. So when we have a profit in a cyclical name that is well above market level profit, then we're going to take that out and recycle that. We like Amerigo. We may get a chance to buy it again if it drops and we see, lower valuations. But again, buying at 3 times cash flow versus today, even at the optimistic end of projections going forward, it's about 12 times cash flow. So yeah, we like to buy it when it's cheap. There's a margin of safety, and that's what we got. And we got about a 270% profit. We will definitely take that.
Yeah, exactly. And, just to add on it a little bit, even back in 2012, BMO Capital Markets, they labeled copper their top commodity pick for 2012, arguing the supply disruptions would lead the price continually higher. JP Morgan was saying the same thing. I believe even Goldman Sachs, was indicating the exact same thing. Was saying that, copper prices would hit about $5 per pound and, remain there due to the lack of supply. All of them were wrong. Again, it's just, why incorporate that into your investment philosophy when it's just so dynamic? It's just out of your control. Focus on the micro, not the macro, the quality businesses that you put in there. Yeah. Anyways, I'll stop.
Yeah, and if you want to take advantage of cyclical commodity based businesses, like this is one that we do like. It's less risky than a pure producer, but there are times to buy it and there are times to bank the profit and put that into more predictable capital compounders. We took advantage of a time to buy it. We might even buy Amerigo in the future again. But we want to buy it when it's a cyclical low, not a cyclical high. Maybe that high goes on for a couple more years.
We just don't know.
We just don't. That's what we're trying to say. And I think it's the smartest people are able to understand their limitations. And you should understand that, forecasting, it's folly. And we, Brennan brought it back to the micro on the individual level. I was talking big picture, looking at all these analysts that are very smart, successful individuals over the long term. And it aligns with the micro look at this individual company there. These are smart individuals. Let's listen to them. And that's kind of let us guide us on our decisions. And that's what we're trying to do. You want to borrow from people who've done well in the past. All right, let's get to our third segment. Unless you guys had more. We're just
I could go on and on. I could bring in some philosophy quotes and whatnot. But
you know what? Those segments we'll probably add and some elaborations on those individual other companies in our upcoming webinars that we do too. We'll put them in there. And we're going to Vegas to do a talk. We may put that in there. I may request that Brennan puts that into his presentation because that's all he's got. So we'll put it in there.
All right. I also have knits.
Brett's kicking us out. Well, yeah, we did.
That's what Ryan said.
Cypher's Natroba is treating Brennan's head lice, right?
Yes.
About time.
We're constantly combing stuff out. Everybody was really loving that, Brennan.
It was pretty funny. My
Isn't
girlfriend,
it?
even
After my talk, it was weird how people kind of stood back. And
yeah, they were avoiding me.
Yes, it's true. All right, let's let Brett get to hims and hers.
Yeah, HIMS and Hers is a company which, even though it's going to have a dog of the week here, it's a company which I've just been interested in following because it's really been that go quick, break rules type of company, which is always just interesting to follow in general. So, like I said, HIMS and Hers, dog of the week, symbol HIMS, HIMS on the New York Stock Exchange. They operate a telehealth platform that connects consumers to licensed professionals. The company offers a curated range of prescription and non-prescription products on a subscription basis with a focus on personalized healthcare. We've covered the company a couple times before, but it really is just an interesting company, pushing boundaries, making headlines, that sort of company. And the stock's just had such a volatile year, trading up to over $72 at its intraday peak. And in the last few days, it's traded lower than $17.17, with the stock being down 59% over the past year, 43% over the past month, and 33% over the past 5 days. So very volatile company, but it's had a very poor, really last few months especially. So just a quick background to the headline-driven events. The company has benefited immensely with GLP-1 drugs over the past couple of years as it's been able to compound the injectable version due to shortages initially, but then once that shortage was declared over by the FDA, it shifted to the personalization, which allows still for compounding, which is questionable, and we'll get into that. But HIMS did actually have a brief partnership with Novo Nordisk, which is the owner of the patent for semaglutide under Ozempic and Wegovy, really household names at this point. But that partnership quickly fell apart as HIMS just kept selling the compounded versions instead of the branded versions by Novo Nordisk. So just this week, HIMS announced that it would start to be selling semaglutide pills at $49 a month, roughly only a month after Novo Nordisk pills became broadly available. FDA approved it at the very end of last year, and they were selling it at $140 or are selling it at $149 a month. So HIMS was clearly price cutting them, undercutting them by about really 2/3. So this is quite different from the prior launch of the injectable form, as there's no clear shortage. The pills are in supply. The injectable variant is obviously in supply now as well. In HIMS' announcement, it even mentions the same active ingredient as Wegovy, which the FDA just does not like. Only a couple days later, the company pulled the product from its service and is not selling it anymore. And this is due to the FDA announcing that it intends to take action against non-FDA approved GLP-1 drugs. As I mentioned before, for the injectables, the FDA was allowing compounding on a mass scale due to a shortage. It didn't need to be personalized. It just was not enough supply for the entire market. So compounding had free reign for the first chunk of semaglutide at the start of when it was first approved. But that's not the case here. And you can argue the personalization, which HIMS has been relying on to sell the injectables for the past, really since May of 2025, has just been skirting the rules. And it's not different enough from the branded versions. It's only a dosage change. It's not an allergy thing. So you can argue on that front even. In the FDA release, though, the administration directly calls out HIMS and Hers. The company is very clearly the target of this release, as it has just constantly pushed these boundaries. The FDA mentions that the non-FDA approved compounds cannot claim that they are generics or the same drugs as the approved FDA versions or the same active ingredient or produce the same results, which in the HIMS and Hers news releases, when they're actually directly saying that's the same active ingredient, and then you see the FDA one day later discouraging that's a bit of a clear, we don't want you to do this. I don't know how you can make it any more clear than that. So right after that, effectively, HIMS and Hers pulled the drug from the market. Then only a few days later now, Novo Nordisk takes legal action against HIMS and Hers. to protect its patients from unsafe knockoff Wegovy and Ozempic semaglutides. So really that comes out to the impact of this is really, will there be legal payments, settlements, fines, either civil or criminal from HIMS and HERS? And then on the company's operational side, since we can't really talk about in depth the legal, we'll probably see that more over time as further headlines come out, as further decisions or any legal settlements come out. But we're not lawyers. We're not going to be able to say what is going to come out to there, but that is a risk there. But the one which I really want to think about is if this actually pushes for the removal of injectable GLP-1 drugs. Roughly 35% of the company's revenue is from the GLP injectable drugs, not the pills, not what was really available for one day, but for the past couple of years now. Does that actually get pushed back on now? Because it was always been in this more gray area than anything. So do we actually see pushback from FDA now that they're clearly have stepped past the line? But that said, I have seen comments anywhere where this is brought up is HIMS and HERS is more than GLP-1, which it is. That is without a doubt. They offer other weight loss treatments, mental health, dermatology, sexual health treatments, but it is 30 to 35% of the revenue, as well as the cross-selling opportunity, which is something which HIMS and HERS has really been pushing on. It has been a core part of their strategy is to get a person get onto their service for one drug, but then you cross-sell them onto another. You bring up that average revenue per subscriber up, and that's the chart which I have on the right. You can see there that big inflection point in 2024. That is when GLP-1 started. It is a clear inflection point, and it brought up the average sales per user as it was a premium service, but also then you get the cross-selling. Further, the stock was previously trading at a very high valuation when it was trading in that prior $60-ish range. So the company, it made sense to have a premium, and it was massive growth with 60% revenue growth expected for 2025. But the engine behind the growth for the past couple of years was the GLP-1 drugs. The other segments, yes, they were growing. Yes, they should deliver some value. It's not a vaporware company by any means, but that premium should collapse now. If you do see, even if it's just a pill form, do you see subscribers say, hey, I don't want to get jabbed with the needle every week. Correct me if I'm wrong there. So would you rather take a pill or get jabbed by a needle? Personally, I would take a pill. So do you just have people naturally move away that you can't have the more convenient opportunity or convenient treatment option? Or do you just stick with it because it's a bit cheaper? That's the question. I think some would switch over, some would stay. But it's overall, it will create a drag on their overall growth. And now the company's trading at about 30 times trailing gap earnings, which is not the valuation of a steady state business. It does still include some growth in the valuation, but it's just not the same level as it was before. And it is just, overall, I really just want to highlight this as it is an interesting company to watch, and it really does show the risk of these biopharma or telehealth companies when you are really pushing these boundaries. You see this across all industries, is whatever regulatory body, if you are constantly pushing boundaries again and again, eventually it'll probably bite you in the ass. Is that to what degree here? That's the question. Is it going to be just a civil lawsuit? Is it going to come out to nothing? But what I can tell you for now, it is our dog of the week. And we, just for disclosure, we do not have a position in this company, because whenever I do one of these more negative segments, we always get accused of being short or waiting to buy it at a lower price. So thought I'd mention that.
No, it's an interesting business, interesting model. The revenue growth has been tremendous. It has inflected into like operating profitability, but again, like it's still 30 times forward gap. So it's not expressively cheap. Even like we've lost 70% of the value at it. So it's a company we'll watch, but there's certainly now a lot of kind of existential threats and direct threats from some of these lawsuits. So we'll see how far that pushes forward. It may be a business that washes out, and then there may be an opportunity. So we'll continue to watch it.
Yeah.
Go ahead.
You go first, because
okay.
I'm just going to say after.
It's been one of these retail favorite companies, which we've seen before, like with a 2021 super hyped up, the retail mania period. Many of those companies ended up coming back down, and then they can actually fit the reasonable price of our criteria. Eventually, it just takes really the interest to die down for a year or two.
Mm-hmm.
So yeah.
Yeah, and all I was gonna say is I'm just like reading the comments. This is just a we should do a quick segment of reading the past comments on other hims and hers uh, segments where this one person says, "Dude, I came for hims, but your analysis missed the entire story. They're not a GLP-1 company. They're a health platform company. You know, you'll be saying there is no margin of safety from now through a 10x. I mean, hopefully they can turn her around. But there's another one. I also watched your podcast for hims. You have no clue. Most likely failed to recognize other disruptors. All right.
Mhm. Okay, well, it's down significantly over that period,
Exactly.
and the
Yes, it
business
is.
is
This was
in
11
some
months
is
ago,
in
these
trouble.
comments.
Yeah, so in
Yes,
some degrees, yeah.
exactly.
So okay, all right. Let's move on. We might as well go, and we'll bring in Rahil. He's going to look at DBOX, a company we recently interviewed. It was a good interview.
Yeah, DBOX. Yeah, we interviewed them a month ago. The interview went well. We came out with good impression of them. So let's go through DBOX. For those who don't know about DBOX, basically it is the company that wants your chair to have stronger feelings about movies than you do. So it's a DBOX builds motions and vibrations for seats and platform. So when you are watching a movie, gaming, or in a simulator, your seat literally moves and buzzes in sync with action on screen. Looking at the revenue by segment, the company has two main lines of business: system sales and royalty. In other words, they get paid when they sell you the seats and then again when the seats go to work. Let's start off with the system sales. In Q2 fiscal 26, system sales were around 1.6 million, a year over year growth of 30%, driven by theatrical sales, which jumped 40% to 6.4 million, as more moviegoers pay up for premium experiences like D-Box motion seats. Over the last few years, sim racing has gone from niche hobby in the basement to a legitimate esport. Several large sim racing partners have plugged D-Box technology into their expansion plans for commercial values, and therefore sim racing revenue was up 23% to 2.6 million. Looking ahead, I expect system sales to remain strong, mainly driven by theatrical. However, I expect sim racing and simulation revenue to remain relatively flat over the coming quarters. Moving on to the rental and maintenance revenue, think of this as royalty and slash recurring revenue. Even every time the seats shakes and wiggles, D-Box gets paid for that. In Q2 of fiscal 26, revenue was up to 40%, mainly thanks to higher theatrical usage and new screen installations. I expect this royalty stream to stay solid over the next coming quarters as long as the people keep choosing the D-Box experience. Moving on to the profitability trend, DBOX has been able to generate uh, profitability trends as the revenue continues to grow up. DBOX has been able to maintain strong gross margins of around 55% and stable operating expenses, resulting in strong net income. Net income increased from 2.1 million last year to 4.5 million in the latest quarter, mainly driven by strong revenue growth. Again, because of the increase in revenue, I expect the profitability to stay strong in the coming quarters. Industry trends. So as I was going through the industry, it is pretty interesting environment. Last quarter, domestic box office for the period was actually down about 11% year over year. Yet D-Box still posted a record quarter. If you zoom in on Q4 box office, the overall market is choppy. Last 3 months are tracking slightly negative so far, showing 2.4% down year over year. But premium formats are stealing the show. The picture on the right hand side is about Cinemark, for example, highlights all-time high box office from its IMAX and ScreenX formats. And more importantly for this story, the highest ever revenue generated by D-Box motion seats. So even in a soft box office environment, the message is pretty clear. If theaters want to grow, they have to upsell the experience, and that plays directly into box office wheelhouse. Looking at the valuation, the company has a really strong balance sheet, trading at 3.2 times current ratio. 18 times cash, 8 times price to book value, and debt to equity of 56%. Looking at the income statement ratios, trading at a trailing 22 times price to earnings, 3.7 times sales, and EV to adjusted EBITDA of 13.4. The company is going to be coming out with Q3 results probably in the next 2 days, and I expect the numbers are going to be better, so that the ratios are going to get cheaper over the coming quarters. In conclusion, revenue is growing year over year, and the real engine is theatrical. The movie theater side is doing the heavy lifting, while simulation, training, and sim racing are more or less trading water so far this year. Under the hood, though, the mix is improving. More of the money now comes from recurring revenue, while usually means better margins and more visibility. The flip side is that this is still a project driven business. Results can swing around based on when systems are delivered, and they are at risk of if theater chains delay or cancel projects. One last yellow flag for current or potential investors. Deferred revenue dropped from about $3 million in Q1 to zero point 0.7 million in Q2, which is basically the company telling you we had a great quarter, but don't assume this exact level of system sales repeating next quarter. So DBOX today looks like a small but growing motion tech company, better mix, better patterns, real momentum, but still with some lumpiness. That's pretty much it on Big Box, DBOX.
Yeah.
Yeah, I think
Great
it's
summary.
a good summary. We had a good interview with management. The growth is strong, but the flags there that you're looking at are, we want to point those out as well. But no, I think it is. I mean, I've enjoyed their actual product in theaters. It's very cool, and I think if they can continue to sell, there can be some lumpiness there, but. I wanted to ask, this is, I mean, sort of related, but not completely. Does anybody know what the 2025 world box office, like that last year, what movie had the highest grossing? Does anybody know?
Last
You
year.
guys, come on.
I don't know any movies, so
Yeah, it's true, Brennan. Jaws is like Niza 2.
Oh yeah, you were
Niza
saying
2.
that, yeah.
Yeah, it's crazy. Like, first of all, I didn't know there was a Niza 1. So, I mean, and then Niza 2 did 2.25 billion worldwide. Domestic, so here, like North America, 23 million. 1% of its sales. Foreign sales were 99%. And then Zootopia 2 was second at 1.8 billion. So, a movie that I hadn't even heard about, and I am going to, because apparently you can get it now. So I'm gonna check it out. It's gotta be pretty cool. So. I mean, but I think going out to a theater needs to be an experience now, because it's so easy to just sit at home and rent a movie, and people have big screens. So, if you can add something to it, like, you're actually getting buzzed around, and it moves around motion. That's very cool. So, it is something that I like the product. The valuation's right there at 22 times. They may come down. If they do, it may be a company we'd look at. Now, I want to get the heck out of here because I've got 2 client calls right now, so I got to get to one. I'm just going to get to my extro here. If you're watching this on YouTube right now, smash that subscribe button. If you are listening to this whenever you consume or wherever you consume your podcast, rate and review us. And as always, keep your questions coming into our Your Stock, Our Take segments. We'll endeavor to answer those on a weekly basis. Thanks to everybody who came out to the World Outlook. If anybody wants to go to Vegas and see me and Brennan there, we will be in, 22nd to the 26th at the Vegas Money Show. Where is it, Brennan? Do you know?
I think it's at Caesar's Palace.
Paris?
But
Caesars? Okay. Caesars. Nice.
I don't know.
We're going to figure that out on the fly.
Yeah, we gotta figure that
Check on the Money Show website, or we'll send it out with a link in this, and you can visit us there and stay in Brennan's room. So,
Yeah,
okay. Thank you very much in profitable investing.
Thanks, everyone.
Thank you.
Thanks, everyone.